Okay, folks, welcome back. It is Wednesday, October 16th, 2019. This is our midweek market review for the ICT Mentorship. So we're looking at the dollar index. This is our daily chart. We finally made our way through all this price action and down into the first level of sell side liquidity. So we had that run here. That was our draw on liquidity for near term. The next is this short-term low, which I didn't speak too much about, but it is the next one. The next intermediate term is this low here, relative equal lows, volume imbalance, and bullish order block. So we'll be looking for this as a potential continuation for the draw lower on dollar. The buy side liquidity rests here above these equal highs. Very, very short term sell side liquidity, and then again, intermediate term sell side liquidity rests here. I want to talk about this area right in here. And this day, on the 11th, which happens to be on last Friday, I mentioned in our weekend review, I wanted to see us continue with large ranges all the way through to a straight shot into these equal lows here. That was the high probability condition. Okay, so I said, and go back and listen to Friday's video again, and you'll get a better understanding of what I'm about to say. I said that if we get a candle that opens lower and doesn't trade back up into this area in here, it will create a fair value gap. I'd like to see that fair value gap remain open and be a breakaway gap, because what that would indicate is it's a lot more selling pressure to take us below here and then here and here with very little resistance. Okay. I stated that if we come back up and fill this fair value gap, should it form, which it did, this would create a low probability condition. Now, let me kind of like flesh this out a little bit, because low probability is not improbability. Okay, month one content teaches low resistance liquidity runs, how to look for very low resistance price runs into specific levels of liquidity. That's what you're learning here, high probability trading. There are going to be times where the market still goes where we think it's going to go, but it's going to be met with high resistance, not low resistance like we look to trade in. It'll have high resistance. Now, you may look at this and say, well, how is this high resistance? Okay, I'm going to show you in price action when we go over to euro and cable. But for now, the distinction between the two is very important, because if you're going to be trading with live funds, it's easier to trade in low resistance liquidity runs. The difference in the delivery of price, if you look at how this price action was offered in here, go back and look at the definition of high resistance and low resistance when I taught in month one. This is going to be a high resistance liquidity run because it's offered as a balanced price range. There's a lot of back and forth in here, as I outlined last week. While we still saw price go to where I outlined it, it was rather fickle and just it's not as clean and as pure as you want when you have very low resistance liquidity runs. Just know that everything I outlined here happened, and it was to script. The things that I said that would be problematic, creating the scenario that would basically call this a low probability condition. Again, stressing the fact that low probability is still probable. It just means that in the grand scheme of things, high probability is what we're looking for. High probability, low resistance liquidity runs. Now, a high probability, low resistance liquidity run, as outlined in month one content, will have very easy price runs. It'll be big, smooth runs up. It won't be a lot of jagged, deep retracements, consolidations, false runs, then pulling back and hitting stops and then going again, and having all these intermittent type spikes before the actual move unfolds, as you'll see in euro and cable. So I want you to really study since last Friday. So we want to look at today's price action Wednesday, Tuesday, yesterday, Monday's price action, and then on Friday's price action. You want to study the dollar index, the euro dollar, and the British pound versus the dollar. Look at the 5 minute, the 15 minute, 30 minute, hour, 4 hour, daily. Really break that down and contrast that with when we see very clear high probability low resistance liquidity runs. You'll see the big difference. It'll be a stark contrast between what we're going to look at briefly here and then what we've seen in previous high probability low resistance liquidity runs. Okay. All right, so that's it for the dollar. We're going to go over right into the euro. And this is what I shared on Twitter. Obviously, you guys weren't seeing all this stuff up here because I don't teach mentorship on Twitter. But I like to share a weekly objective, or at least an example, for the free members that don't have the ability to be with us. I like to be an inspiration for them because that's just my nature. So I'm quite certain some of you are probably wondering why and how I entered here with very little drawdown. It had less than 2 pips draw. A weekly objective, or at least an example, for the free members that don't have the ability to be with us. I like to be an inspiration for them because that's just my nature. So I'm quite certain some of you are probably wondering why and how I entered here with very little drawdown. It had less than 2 pips drawdown from the entry. And this is mitigation. Okay, so what I was seeing at the time when I turned the chart on and started recording it, I saw the low here, the low here, and while they were equal, we still had a stop run here. So see the low in between? Lower run here. So there was an upset in liquidity. That's all I need, because I know that other brokerage feeds on live accounts, these lows would actually be lower on some of them and take this low out. I don't require that, okay, especially if I have a stop run in between the equal lows with the premise being bullish. What made the euro dollar bullish? Well, what we outlined here on the dollar index and the fact that we had this draw in liquidity. Dollar's weak. That means foreign currency is going to be allowed to rally. It's going to be hard for it to drop down. Okay, it's going to be easier, or let's say it this way, it should be easier for it to rally. Now look at this price action right in here. We had the run here. The next candle, we trade all the way back down, completely close it in. So we filled in all of this BISI, immediate. So it was an immediate rebalance. No fair value gap, no liquidity void that was left that had to come back to at a later time. This was an immediate rebalance. Put that in your notes because we will be talking about that this weekend. So we had an immediate rebalance, and then price rallied back up through it again. So look at what we have here. We have a 5-minute candle going up, a 5-minute candle going down, and a 5-minute candle going back up. This whole business in here, okay, is a balanced price range. So when price was trading back down on this down candle, and in the next candle here, I wanted to get in when it was going down. I felt confident that we weren't going to go back inside this range, not even to a mean threshold of this range. Wouldn't be necessary because it's balanced. And we had relative equal highs. So we had buy side liquidity resting above this high here. And I'll go out to an hourly chart in a moment and let you see what these levels are. So I was attacking, buying here, and attacking the liquidity resting above the relative equal highs, which we'll see. Here. So we had relative equal highs, and then this high here. So I was telling everyone in that video to focus there. And let's zoom back in. And if you wouldn't have taken that trade, you have your standard mean threshold of bullish order block right here. Price trades down to it here. Add the spread. You can go long on that. Also, you have a optimal trade entry. Okay, trades down into sweet spot and almost to the 79% level to the pip, and add the spread, and that would be your objective for going long there also. So there's 3 different conditions that you could trade on in this general area. We have the mitigation block. Okay, now what makes this the mitigation block is the fact that we had, number one, the premise bullish on euro dollar, bearish on dollar, and We had a stop run down here. So price rallied through this high. So if we had this low being lower than this low here, much more significantly lower, then this would be deemed as a bullish breaker. But because it doesn't really form the breaker here, it is a mitigation block. So anything that were placed on short here, they have to mitigate that and take it off before price rallies. Okay, so IPTA holds price in here, allowing mitigation. And when you have that, and you have the understanding, you grow very comfortable when price is in consolidation and holding before the price runs. It's not fun to hold into it, but it allows you the confidence to still stick with it, because it spends a little bit of time in here and then came back, allowing mitigation again, and then takes off. Now again, all I want to do is target the clear level above this high, because that's free level and I have no problem teaching that level. But the red level here and this area up here, let's take another closer look at that. But I want to take this off because it's going to be a problem on the higher time frame. If I don't, it'll be too much clutter. So let's put us into an hourly chart, and we'll zoom out one more time. So why was I saying IPTA would not likely seek to purge those equal lows? Because we're part of this market maker buy model, and they're going to be running the liquidity here that we outlined weeks ago. Okay, so let me take this off. Okay, so we had an imbalance in here. Price came down, filled that, rallied, consolidated, mitigation, entry, and then rally up above these relative equal highs. Not holding for here, not holding for the fair value gap in here. It's on a 4-hour chart. Let me show you that, because I'm sure you're probably saying, what is up? Okay, there's our imbalance in here. And this wick, watch what happens when we go back down in the lower time frames. Go to a 3-hour. See that? Just the wick and this here. So we have this candle. Now watch when I drop down into a 2-hour. Some of you are emailing me, asking me how did I get the MT45 that allows all these multiple time frames. And it's just the avatrade.com website, and then opt for the MT5 demo account, and I guess it'll set it up. Let me take this over here so you can see that little gap right here. That's what's highlighted. Okay, and it's on a 2-hour chart, and trades right to the bottom of that fair value gap here. Notice that we went a little bit higher from the original gap. Doesn't matter, the original gap, you want to use that because it's going to remember that. Remember, IPTA will remember the first signature. Okay, the first PD array formation, whether it be bullish or bearish, the characteristics that make that PD array what it is, you want to remember that in your chart, or at least not remember, but you want to log it in your chart in its original state, because IPTA will be sensitive to that. And you can see how perfectly it hits it as a daily high today. All right, so smart money reversal, low risk buy, reaccumulation, and then now we've cleared this area here, which I shared on Twitter. I don't know when I shared that, to be honest with you, but I shared it again. I made a notation of it today in Twitter, referring back to that original post. The next area of liquidity is resting above this high here if we get through this fair value gap. All right, moving on over to cable. Cable, we had our BISI here. I wanted to see the original bullish order block. I wanted to see it trade down to that. I was waiting for that to get some kind of reaction. They had all kinds of news come out for Brexit, how they have a potential deal in the works or whatever. And like I said, I don't know what to do with Brexit. It's a completely new thing with me. I've never experienced this, so it's a learning curve for me to experience, just like it is for you. And anyone that claims to know what the ramifications are going to be, I said this the last time regarding Brexit and my comments about it, Anyone that says they know what's going to happen if they get a deal or don't get a deal, I don't care what you believe, okay? Most of the time, what would be commonly referred to as the expected outcome or the norm. What's norm? I mean, we have a European Union for the first time, okay? And if this country is able to annex itself from it, well, great. I'd like to see it happen personally because I don't believe in the European Union. But if it does or doesn't, the ramifications from a central bank level, you don't know what that's going to be, and I don't know what that's going to be. Okay, so we have to trust what Price is telling us and stick with that, and that's what I'm doing here. Okay, so I also mentioned last couple of weeks, I said if you do trade cable and you don't know what you're doing, it can very easily hurt you. And these intraday swings of 80 to 100 pips in like 1 and 2 minutes, yeah, you got to know what you're doing. If you don't, you're really going to hurt yourself, especially if you're not listening and you're trading with live funds. You're not supposed to be doing that while you're in the mentorship. All right, so we reached up into the breaker here. If you recall, I said that we would be back up into this area probably around December. Go back and listen to the recordings. We got there pretty quick, ahead of schedule. So now that we've hit this breaker, I am not sure at the moment what we're going to do at all. I don't have any realistic objectives to draw your attention to other than these equal highs here. Okay, so I'll draw that out now in this particular recording. But just know that I don't have confidence to the degree to say it's going to go up here. Now, remember, I said that we would be up here around December. We got here in really short order. If we continuously move lower on the dollar, then this will be our objective. Okay, we'll be looking for the 132s, which is amazing, but it is what it is. So I'm sticking to the sidelines on cable. I did a very small little trade today. I got about 79, 78 pips, something like that. A rally in here. And I want to drop down into a 15-minute time frame. Okay. All right, let's go over the contrasts between what I was stating about the dollar index and this whole business in here about if it trades up to the fair value gap immediately, that's low probability. Now again, that is not improbability where it's not going to happen at all. Low probability is it can happen. It's just likely not to happen as well as you would like to see it happen. Okay, and I'm kind of like paraphrasing that to fit my view on price action. Okay, so when I deemed a setup a low resistance liquidity run, that's high probability. A low probability, high resistance liquidity run is something that I try not to trade. Sometimes I get into a trade that looks like a low resistance liquidity run and manifests itself into a high resistance liquidity run where it's still, I'll stick with it, but I'll reduce the exposure by taking some of the trade off and just letting it, pan out if it can. Most of the time when I do that, they don't pan out. I either get stopped out or I take a loss. Just know that that's not what you're trying to learn here. You want to know that this is where the likely draw on liquidity is, and the market may want to go there, but the conditions that lead to that are going to be very important. Now, this is one signature that I gave you as kind of like a preview, because these types of things I don't usually talk about in the commentary because it's advanced. Okay, it's things that I haven't taught yet. It's in the algorithmic principles. All those things that none of the charter members know yet. It's all stuff that's planned for 2020, these types of lessons and the conditions. Okay, there's not a lot of them, but they're very specific things that I like to look for that I'm going to be willing to share with you. There's a lot of things I'm not going to share because people are just basically, mistreating it. They're abusing it. They're talking about it on YouTube, and it's out there. I know what's going to happen when I teach it, but now that I see the level that it's being shared and taught and everything else, or tried to be taught, okay, they're attempting to teach it. They have no idea what they're doing. It's offensive. So I just know that what I'm going to give you is light years beyond anything you're ever going to see. But just know that it's going to take a lot of time for you to be able to apply them. And the conditions that I outlined for this fair value gap, should it form, if it comes back up and fills that, it would create a low probability state for Eurodollar and cable. So let's go over to cable first, because we were working on that one. Look at what we see here. Yes, we have a imbalance here, BISI, buy side imbalance, sell side inefficiency. Our normal expectation would be to see what? Price trade down and rebalance that, which it does. Look at how price behaves after. Yes, we get a run, then it comes back, and then it runs, and it comes back, and then it runs, and it comes back, just jagged. A lot of this reach and give back, reach and give back, reach and give back. That is a high resistance liquidity run. All of the normal characteristics, equal highs being taken, relative equal highs being taken, another level of equal highs that are there, they'll be ready to be taken again. Those signatures are there, but look at the type of price action that has been shown. It's very, very hard to trust these and not experience a lot of retracement. This is what high resistance liquidity runs look like. Now look at Eurodollar. Eurodollar again, we have this nice pop from here up, a lot of consolidation. A run doesn't get the equal high. See what happens? Runs here and then deep retracement, run stops. Pops, runs a level of stops in here again, and then rallies. You see what I mean by that? That's a high resistance liquidity run. All of the signatures are there. Okay, all of our levels that we had on our higher time frame chart, they have been swept as we would expect. But it's been done on the basis of a high resistance liquidity run. Now, go back and look at other examples where we've outlined, or at least I have outlined, things, and I told you what to expect in terms of it being a low resistance liquidity run, and then how smoothly price runs right up into the levels, and there's really no opposition whatsoever. It's just a really buttery smooth run right on into profit. That's what you're learning here. I can show you these things, and it's important for you to learn about them, which is really the basis of this weekend's lesson in the Friday recording for our weekend review. I'll give you a little bit more information about high resistance liquidity runs and the immediate rebalances. So, because knowing those things will help ferret out trades that are questionable. Once you get into them, they morph into something entirely different. As soon as you see it, you really want to start managing it differently. Okay, you don't want to treat it the same way you would with a high probability, low resistance liquidity run, where it's just a clean run right into your profit. Very little drawdown, very little pullback, not drawdown, very little retracements at all. Whereas you have all this sloppy chop, someone that's versed like I am, I see what I'm looking for and I know I can work in it, but this is not my ideal scenario to trade in. And the trade I did in cable today was very, very small. It was literally 50 cents per pip. And I don't trade like that. I don't trade with leverage like that. But because I wanted to engage with it, that's what I did. So it was really nothing in terms of a great deal of money at risk, but I needed to be a part of it because I'm learning this whole Brexit thing. So by using my tools and putting something into it, I was able to see what was available in terms of liquidity, how the price behavior worked with my order, how it attacked the stop if it did at all, which it didn't, but nonetheless, how it behaved. And what we see here, this is high, again, I'm going to say this in closing, it's high resistance liquidity runs. This is what we've been seeing this week and from last week. They are still panning out, and the things I'm giving you from a higher time frame are developing and being delivered in price, but it's being done so in such a way that it's going to be very difficult for a new trader. For instance, you've learned the low resistance liquidity run in month one. But if you tried to use that, it would be met with opposition because of the conditions that are in place right now based on what the dollar had to deal with in this balanced price range. Okay, so again, if this fair value gap here would have remained open and we just traded down with large ranges, what the translation would have been for cable is we wouldn't have had all this sloppy mess. It would have been just beautiful large candles on the upside, and Eurodollar, same thing. We would have big large candles without all this back and forth, choppy false runs, stop out, and then run. Okay, this is not low resistance, high probability runs on liquidity. This is not high probability, low resistance liquidity runs. Okay, it's high resistance runs on liquidity. Okay, if you're not paying attention, if you don't really understand what I'm saying, okay, it's very easy to assume what I just said was the same thing. It's not. It's absolutely not. Go back and study the low resistance liquidity runs portion of month 1 content. Study that lesson again, okay, and then look at the signatures in Euro and Cable in the last couple days, and you'll see that there's a stark contrast to what I taught in month 1 versus what we see here. It doesn't nullify what my analysis gave you in terms of where it was going to go. It just means that the conditions that you're trading in are different, very different, in the sense that you're probably more likely going to get stopped out, or you're going to miss your fill, or you're going to get shaken out of the trade because of your inexperience. Okay. So last bit of business, and I'll close this video. Here's the dollar CAD. We had some news for dollar CAD. I did not trade this. This is how I annotated my chart, and this is what's going to go in my journal. We have this low to high. That's our dealing range. So I'm using the wick high and wick low for that purpose. And I'm using the bodies of the candles of this last up close series of bullish candles, which is a bearish order block. And the bottom of the candle's body and the top of the bottom, the top of the candle's bodies here. So we have the close here and the open on this candle. The equilibrium of that is here. That's what this line is here. It hits that, and this low to high in terms of wick, the equilibrium is this level. It does hit that and almost gets it again, just falls short of it. And then the obvious level that you would use for your trade, either for targeting or for entering on a short, would be the bottom of the bearish order block. Okay, this is the point at which you enter and you allow for all these other factors for your stop placement. Price runs, relative equal lows, that's your first profit target. Then the sell side liquidity pool, do 5, 10, 15, 20 pips below that, and you'll get the run for the sell side liquidity here. Okay, so that's something you guys can study as well. And until I talk to you on Friday, be safe. I will catch up with you by way of Twitter, I'm sure, with something if there's a noteworthy thing that's occurring in price. I appreciate everyone sending me your well wishes for my mother-in-law. But it's not necessary. I asked you guys not to do that. So that's why I'm pretty quiet. I'm dealing with that with my wife. And also I'm purposely dialing back my interactions on Twitter. Okay, so my intentions are focused primarily on you guys. Until I talk to you on Friday, I wish you good luck, good trading.